Welcome to Earnings Intelligence. All right, let's set the scene. The year is 2002. The dot-com bubble has completely burst, the markets are a total mess, and pretty much every investor is running for the hills. For most companies, it was just a brutal, brutal year. But for one company, it was, in the chairman's own words, a banner year. Today, we're going to dig into Berkshire Hathaway's 2002 shareholder letter and figure out how they didn't just survive the storm, they actually used it to their advantage. Okay, let's just jump right into the numbers, because they really tell the story. In 2002, the S&P 500 got crushed, down more than 22%. But get this, Berkshire Hathaway's book value, which is basically the company's net worth, grew by 10%. I mean, in the middle of that market chaos, that is an absolutely massive win. They beat the market by over 32 points. And hey, don't just take my word for it. That's the very first sentence from Warren Buffett in his letter that year. He doesn't mince words, he just comes right out and says it. After a couple of pretty tough years for them, he wanted everyone to know that 2002 was a huge success. So what was their secret? How'd they pull this off? All right, here's how we're going to break it all down. First, we'll look at why they had such a great year when everyone else was struggling. Then we'll dive into their secret weapon, the insurance business, and the thing called float. After that, we'll see what they did with all that cash, we'll explore the philosophy that drives all their decisions, and we'll wrap up with 3 timeless lessons for every investor. Okay, let's dive into part 1, a banner year in a bear market. So what exactly went into making this such an incredible year for them? Well, Buffett himself actually lays out 4 main reasons. First off, all their non-insurance businesses, like manufacturing and retail, did incredibly well, even with the economy slowing down. Second, their insurance operations grew their float by a ton, and it cost them almost nothing. And don't worry, we'll talk more about what float is in just a sec. Third, they went out and bought several fantastic businesses. And finally, even their stock portfolio managed to beat the market. Basically, it was like all their cylinders were firing at once. But here's what's really fascinating, Buffett's honesty. Back then, CEOs were doing everything they could to pump up their numbers with sketchy pro forma accounting. But Buffett, he did the exact opposite. He pointed out that their earnings actually looked a little too good because they got lucky. They didn't have a major catastrophe to pay for, and they had some one-time gains. He basically said, hey, if things were normal, our earnings would have been about $500 million lower. It's just a masterclass in transparency. So that brings us right to section 2, and it's a big one. The engine, insurance, and float. Look, if you want to understand Berkshire, you have to get your head around their insurance business. It's the whole engine of the company. Okay, let's talk about this magic word, float. What is it? It's actually pretty simple. Imagine you pay your car insurance premium today, right? But you probably won't file a claim for months or maybe even years. All that money that the insurance company is just holding on to for you in the meantime, that's the float. It's basically a giant interest-free loan they get from all of us, their policyholders. And when I say giant, I mean staggering. By the end of 2002, Berkshire's float had swelled to more than $41 billion. Think about that. $41 billion in cash that wasn't technically theirs, but that they could use to go out and buy stocks or whole companies. And this wasn't some lucky break. Just look at the long-term picture here. They went from just $20 million in float back in 1967 to over $41 billion by 2002. That is not an accident. That is patient, deliberate, genius-level empire building brick by brick. Now, the real magic isn't just having the float, it's how much it costs you. And in 2002, their cost was incredibly low, just 1%. But true to form, Buffett doesn't just take a victory lap. He stops and admits a huge mistake. He says he was dead wrong about the risks at General Re, a huge insurance company they'd bought. He thought they were in great shape, but they weren't. And it took a ton of work to fix. I mean, how many CEOs do you hear admitting they made a multi-billion-dollar mistake? So you've got billions and billions of dollars in cheap cash lying around. What do you do with it? Well, that takes us to part 3, buying businesses, not stocks. In 2002, Berkshire went on a shopping spree, but they weren't flipping stocks, no. They were buying entire businesses to keep forever. And this quote right here, it just says it all. Think about it. Wall Street is obsessed with the exit strategy. How quickly can we flip this company? But Berkshire, they have no exit strategy. They're the entry strategy. They buy a business with the intention of being its permanent home. And you see this in the companies they bought. I mean, take the Pampered Chef. To Berkshire, this wasn't just a set of numbers on a balance sheet. It was the amazing story of Doris Christopher, a woman who started this thing in her basement with a tiny $3,000 loan. And by the time Berkshire came along, it was a $700 million powerhouse. That's the kind of business DNA they look for.
And if you think that's a good story, wait till you hear this one. There was this pipeline company, started right in Omaha. It gets bought, moved to Houston, and eventually renamed, get this, Enron. Yeah, that Enron. So after the whole thing collapses in scandal, who steps in to buy the pipeline out of the wreckage? Berkshire. And they bring it right back home to Omaha. I mean, it's like a Hollywood script. You can't make this up.
And they didn't stop there. They bought the company that makes custom picture frames, an iconic brand like Fruit of the Loom, even the company behind Garanimals, for kids' clothes. It looks like a random shopping cart, but every single one of these companies fits their very specific mold of a durable, well-run business.
Right? Picture frames, underwear, pipelines. What's the connection? Well, on the surface, there isn't one, but underneath it all is a super consistent philosophy. And that's what we're going to dig into in Section 4.
So Buffett has this great story he tells to explain how he manages things. It's about a famous bat boy from the 1920s named Eddie Bennett. And the lesson is so simple, but so powerful. Eddie knew that if you want to be a winner, you've got to work with winners. And Buffett sees his job the exact same way. Find the business superstars and then just get out of their way.
So how do they find these superstars? Well, they actually publish their shopping list for the whole world to see. They want big companies, simple businesses they can actually understand. Companies that make money year after year with very little debt, and this is key, they need the current management team to stay. They are not looking for fixer-uppers.
A big part of their philosophy is knowing what not to do. And in this letter, remember, this is 2002, way before the big financial crisis, Buffett drops this bombshell warning about derivatives. He called them financial weapons of mass destruction. It's just incredible foresight. He's always playing defense, always trying to avoid that one catastrophic error that can wipe you out. When you boil it all down, their entire philosophy is about one thing: understanding what a business is really worth. They don't care about book value. That's just an accounting number. They're obsessed with intrinsic value. And here's a great way to think about it. The book value of your college education is what you paid in tuition, but its intrinsic value? That's all the extra cash you're going to earn over your entire life because you got that degree. See the difference? That's what they're after, the long-term cash-generating power of a business.
Okay, so that brings us to our last section, and this is where it gets really practical for all of us. Buffett wraps up the letter with 3 key warnings for investors, and honestly, they're just as important today as they were back then.
All right, warning number 1, be scared of bad accounting. He especially hated when companies bragged about EBITDA because it ignores what it actually costs to stay in business. He has a great line, there's seldom just one cockroach in the kitchen. Number 2, if you can't understand the footnotes in a financial report, it's a huge red flag. Management is probably trying to hide something. And number 3, if a CEO is always promising to hit specific earnings numbers every single quarter, run. The pressure to hit those targets can lead to some really bad decisions.
So I want to leave you with this question. We live in a world that's just as complicated, if not more so, than 2002. We've got complex financial stuff everywhere, companies promising the moon. So when you look at those 3 powerful warnings from Buffett, which one do you think is the most important for all of us to remember right now?